It's hard.
All right, good morning, everyone. We'll go ahead and get started. It's just after 8 o'clock. And welcome. I know there's some folks here that are here for the first time and some folks that have seen this before. And so we're going to have a slightly different format this morning and want to take a step back and think about why we're here and why we'd like to share this information with you on the economy as we go along. I will start off by saying, I think everybody knows, but in case you don't, I'm Jim Dunlop and one of the managing partners here. And we are recording today's presentation that goes on our YouTube and website for clients of ours who could not make it here today. So if you speak or you're asking any questions, it will be recorded. So just make you aware. Investing is a really important part of financial planning process. And our job for our clients is to be long-term focused. And so while the data is very up to date and very recent, we're still here to think about the long term. And our investing supports our other goals, the goals we have for retirement, the goals that we have to take care of our family, the goals that we have to do good things for others, to be charitable. And so I thought I would start off, instead of just jumping right into the economy, talk a little bit about some financial planning topics. And I want to share about 4 different concepts with you as we get started this morning, just thinking about the broader and more long sense of financial planning. So Chris, I'm going to need you to click back into this because,
okay.
All right, there we go. Very good. I think now it'll work. Oh, it's not working.
Go back, please.
No.
No.
All right, well,
Okay.
oh, there we go. Well, this is going to be a long morning. All right, Chris, just give me an next one. So one of the interesting things is thinking about longevity. And so I thought I would just share this today that if you are 65 today, the probability of living to a specific age or beyond is listed here. So 72% of all women will make it to 85 if they've made it to 65. And 31% will make it to 95. And if we look at these blue charts, just men don't seem to make it as long, but that's no surprise. But if we look at just couples as a whole, married couples, we would see that if we make it to 65, there is a 90% chance one of us is going to make it to 85 and a 73% chance that one of us is going to make it to 90. And I start this off to say the reason I'm sharing all of this is long-term investing matters always. I had a couple who are not here today, but are in their 80s and said, "Oh, Jim, we're not going to be here that long." I said, "Well, you know, there's a good chance one of you will be here for a while yet. And so we need to have a good plan in place for that." And so planning is really important, but so is staying investing. Okay, now it's working. So we're going to go with that. Social Security is another issue that comes up. And again, when we think about longevity, and if we've done any financial planning with you, we've probably had a conversation on the right age to draw Social Security. But just in general, if my full retirement age is 66, every year I wait up until the maximum age of age 70 is an 8% increase in my benefit. And of course, I'm taking a 6.25% discount every year that I take it early. So again, from a planning perspective, thinking about Social Security timing, particularly for a married couple, makes a lot of sense. This next slide I thought was interesting. All right, there we go. This is spending in retirement for households. And you'll notice that, we probably reach our peak spending in our early 50s, and it starts to go down. Now, inflation can erode that, but interestingly enough, you can see the things that are in this travel starts out very strong and goes away. Entertainment also kind of diminishes, but housing always becomes a major issue, and healthcare always becomes a major issue. And so you can see the natural inflation here. So again, when we think about planning for the long term, we might not spend as much later, but we will spend more things on and differently as time goes on. And then lastly, the thing that we want to talk about is staying invested. So we're going to jump into the economics here, but this is a good transition slide. And go back one. Oh. 7 of the 10 best days occurred within 2 weeks of the 10 worst days of the market. So so I've heard it often said by economists that the best days and the worst days tend to cluster with each other. So on days where we have a massive sell-off in the market and we're getting demoralized, say, oh, maybe I should get out, chances are one of the better days is very nearby. And that just speaks to the volatility that we experience in stocks. If you had stayed fully invested in the S&P 500 for the last 20 years, you would have averaged a 9.7% rate of return. If you had missed the best 10 days in those 2 decades, you would have cut your returns almost in half, an average 5.5%. And in fact, if we missed the best 30 days or we missed the best 40 days in the S&P 500 over a 20-year period, we didn't make any money. So again, this is the idea that we need to stay focused on our long-term investing, and that what we want to talk about today really is about more long-term focus, what's happening now and what is the implication long-term. So I'm going to start here with the S&P 500, and we're going to talk, and I want to be very careful. We often have used the S&P 500 as a broad proxy for the stock markets, the 500 biggest stocks. I want to pick that apart here a little bit today, but on October 25th, we were very close, or we have been very close to our all-time high. There is a chance that this morning that the markets will be up today and we could hit some new highs today. I have made the argument, and I will continue to make it, that markets tend to be apolitical, especially in the long term. Now, I suspect that the reason the market is doing very well today isn't necessarily that based on who won, but that we have a pretty clear idea of the winner. I think if we had a period of time with uncertainty like we saw in 2020, where the outcome was less than certain, I think the markets would not have behaved nearly as good today. So markets tend to hate uncertainty and like certainty. And so there seems to be some certainty to last night's outcome at this point. And so markets are, I believe, are responding accordingly. But as we go forward, let's talk a little bit about where stocks are. We look at the S&P 500. This is a chart that simply shows, are we too expensive or are we too cheap? This isn't the performance. This is the relationship between price and earnings. And our long-term average S&P 500 trades about 16 times its earnings, more or less. And we like to see it within one standard deviation. Say, you know, typically the market's reasonably priced when it's between these higher and lower lines. And right now, what we're seeing, obviously, is a case where the market is certainly a frothy and above its long-term average. So, but let's break that down just a little bit over the next 2 slides. I think it's important to separate out the top 10 stocks just for a minute. If we look at the left side, we see that the top 10 stocks are trading at 31 times earnings right now. We look at the remaining 490 stocks of the S&P 500, they're trading at 18 times earnings. So they're not nearly as expensive. So I would argue the market has done very well this year. It has been driven by a small number of companies, as it has been lately. And those companies probably are ripe for correction. They tend to be tech heavy. We know they're Apple, Microsoft, NVIDIA, Amazon, Google, Alphabet, Meta, Berkshire Hathaway, Broadcom, Tesla, and Eli Lilly. Those are the 10 biggest companies today. And that list has changed a little bit. But all this is to say that I think there is probably some good value in a diversified portfolio right now that is frothy as stocks look on the surface. It's probably a handful of names that are probably a little overpriced. and that the market is probably trading within a more normal range, more broadly than that. So we'll talk about the 10 top 10 stocks. Well, there's this magnificent 7 stocks who are part of those. I believe all 7 are in the 10, and they're the tech heavy magnificent 7. And if we look at the left, if we look at the blue line versus the green line, we see the difference in performance, that the green line has done very, very well, and I would probably say is ripe for correction. Probably a little overpriced. We certainly saw that earlier in this year when we saw a bit of a sell-off in those stocks, but the broader market, that blue line has continued to do well. And I believe that that is probably a direct result of a still expanding economy. So just these are tic-tac-toe boards, and the shading does not come through on the projector very well. We are recording this, so you can go online and watch it later if you want. But just to kind of look at broad categories of stocks, again, we have big companies, medium-sized companies, small companies. We have value, blended, and growth-oriented companies. And year to date, we're seeing tremendous growth across the board, especially in our larger companies. But again, I think those top big companies, those big tech companies, are a lot of that story and probably are a little overpriced. Again, staying diversified right now. I think as long as the economy continues to expand, and we'll talk a little bit about that as we go along, I think as long as the economy continues to expand, there's certainly room for the market to do well. I wouldn't necessarily count on these top 7 or 10 stocks going forward. So just kind of give you a sense of where we are. Again, we share this slide a lot, and this is as of October 25th. The S&P 500 is up almost as much as it was last year. The gray line shows market returns for the last 44 years. And we know that probably 3 out of 4 years, the market's positive. But again, the best years and the worst years tend to cluster around each other. So there's no surprise there. But the red dot, again, shows us the worst point in any given year. So even in good years like this year and last year, we've seen some pretty massive drops. We saw the market pull back 10% at one point last year. We've seen the market pull back as much as 8% at times during this year. And looking at that same chart for the bond market is, we'll talk a little bit more later about bonds, but again, bonds tend to be positive most years. They tend to be very stable. We're coming off a very difficult couple of years for bonds, and that was a reflection of rising interest rates. We'll talk about it later as interest rates either stay level or come down, what the implication for bonds are. So just thinking a little bit about the economy and taking a step back from where stocks are really a good measurement or a broad reflection of the attitudes towards where the economy is going. And I think it's important to note that we've really had a strong economy for the last, I'm going to say 16 years, going back to 2008. The only official recession we've had in that time was 2 months during the pandemic, March and April of 2020. That's, of course, this little, a very noted line there. But that quickly changed and recovered. And so we spent 2022, we saw markets down a lot in 2022. We spent a lot of 2022 wringing our hands and worrying that we spent a lot of time that we were going to head into recession. But I think the Federal Reserve did a pretty good job with interest rate policies that kept us out of recession. They appear to have executed that quote unquote soft landing where we were able to raise rates, get the inflation rate down to a more reasonable level, and do that without causing mass unemployment. So we have not seen the stock market, the stock market blew up, but we haven't seen the broader economy blow up. And of course, then the market has recovered over the last 2 years. When we think about recession determinants to call a true recession, again, the last one we really saw was in 2020, is 6 things have to go wrong for the National Bureau of Economic Research to declare a recession. And so the 6 things they look at are real personal income, non-farm payroll, household survey employment, real consumer spending, real and wholesale sales, and industrial production. The only thing that's really starting to maybe flash green or red is industrial production is a little splattered, but you know, by and large, everything's kind of okay. Is it great? No. But if we jump back one slide, you know, going back over the last 25 years, the economy has grown on average at 2% a year. And it looks like that's where we're going to be for a while. That trend continues to go forward. And again, 70% or 67.8% of our economic activity is driven by consumption and the consumer activity. All right, so let's go to the consumer. And again, I think the consumer tends to continue to be pretty resilient here. On the left is if we took all of our assets collectively as a country and put them together, we have 184 trillion and we have about 20 trillion of debt. So the American balance sheet on a whole looks pretty good. Now, I want to back that up and be a little more nuanced there. And I think, you know, I think that we are seeing some signs that the consumer is maybe starting to get stressed. Household debt service is starting to come back again from the pandemic to where it was before. Auto defaults and credit card defaults are starting to rise again. And so those are certainly some canaries in the coal mine on the consumer. One of the things that I think was very interesting last night, and I don't want to talk too much about the election, but just listening to the news last night on exit polls is a lot of people, and we're going to look at the data here, a lot of people were saying that they were worse off economically than they were 4 years ago. You think, well, how is that? The market's doing well, the economy is expanding, but I think there are two real things, is that wage inflation has been okay, but it hasn't been great. And so I think if you're in the bottom half of earners in the country, your salaries and earnings have gone up, but not nearly as fast as your expenses. I think a lot of retirees have been protected because Social Security got raises, the nest eggs got bigger. And so I think this is a dynamic that hasn't affected a lot of retirees, but I think it has skipped, or I think it has affected a lot of people. And so I think we saw that on exit polls last night, that people don't feel they're as good off as they were 4 years ago. And when we start looking at wage growth here in a little bit, and we start looking at inflation, we've gotten inflation under control, but we didn't lower prices. We're just not increasing them as fast, right? We got inflation back closer to 2%, which is the objective, but you know, everything at the grocery store is still a lot more expensive than it used to be, and gas is more expensive than it used to be, and so those are things that factor into this. When we look here at consumer confidence, has still been rising, but again, it's still choppy and below the long-term average. So people are feeling a little insecure, but that hasn't necessarily translated to a massive change in behavior. The consumer is still spending. Now, here's where I think the difficult issue that nobody in the presidential campaign was talking about is this. You know, we're running about a $2 trillion deficit right now. This fiscal year, we're projected to borrow $2 trillion just to pay our bills. Nobody wants to cut Social Security, Medicare, and Medicaid. This is where we spend. This is where the money comes from. Nobody wants to raise taxes, maybe a little bit here and there. But so we heard both candidates not really addressing this issue. And I think this is something that, unless we're willing to make some meaningful changes, we're going to keep borrowing. And the more we borrow, the more we're going to pay in interest on the debt, and the more that's going to eat away. There just isn't a lot of good options or easy fixes here. And, you know, regardless of who won last night, either in Congress or the White House, this is still the math that has to be confronted. And so I think we can continue on for a while. We're pretty good at borrowing money. Our borrowing costs haven't gone through the roof yet, but that probably won't last forever. Where that becomes more challenging, nobody knows. We haven't done it yet. There are certainly people that say we have plenty of runway to go. There are certainly people who are ringing and sounding the alarm bells. I don't think we know the answer to that, but it's certainly a long-term issue that's going to have to be addressed either through higher revenue or less expenditures. And I don't know how you do both of those easily, because if you did, they would have talked about it on the campaign trail, but they did not. And so thinking about unemployment and wages, this is where I think, again, one place that I just want to keep in mind is that wage growth right now is this blue line. Is right around its long-term average, about 4%. After the pandemic, we saw wage growth up pretty high. But when we look at the inflation rate in a few minutes, what we'll notice is that real wages have not kept pace with real inflation. And so I think that that has really probably created more stress and probably influenced the election more than people realized until this morning. Certainly that was, I think, is what we're going to hear more in the days ahead. Thinking about labor supply, again, 70% of our economy is driven by consumer spending. And what's interesting is that, you know, the labor market is still doing pretty well. Now, I'll back up and say we got a really bad jobs report for October. I prepared these slides last week, Friday. We got the jobs report for October, and we only added 12,000 jobs to the U.S. economy in October, which is the lowest we've seen in a long time. However, I think a big part of that, they believe a big part of that was tied to all the hurricane activity that we saw in Florida and North Carolina, and that was a huge economic disruptor in the Southeast United States. So we need to pay attention to that for the next few months. Was it just the hurricane, or is there something broader happening? We do know the market is softening, but unemployment has not gone up. We still managed to create more jobs than we got rid of. And we're seeing the labor force, you know, for the highest in a decade for 18 to 64-year-olds are in the labor force now at a rate higher than they have been in any time in the decade. So, you know, we have pretty good employment. People are working, they're making money, they're spending it. They certainly would like some more. And so then we talk inflation. And again, when inflation is at 9%, headline is at 9%, core inflation is a little lower than that. You can see if our wage growth is only 4% and peaking at 7%, but inflation is at 9%, there's something to be said for that. Now we track both core inflation, which removes food and energy costs because they tend to be very volatile, the blue line. But I think it's also important to understand that a lot of people spend money on food and energy, and so you can't ignore it either. Thinking about inflation, I do think this is a good news slide. This is, you know, the inflation rate for September was at 2.4%. The biggest component of that continues to be the shelter dynamic. So we seem to have gotten a lot of prices under control. Auto insurance has also become an interesting component, and that follows if we go back several years ago. Remember, used cars went way up in price, particularly coming out of the pandemic. Well, guess what? It costs your insurer now more to replace your car in an accident. So insurance premiums have very much gone up, and that's a lagging effect of seeing particularly used vehicles, get more expensive. Is that it's hard for me because I added a teenager to my insurance policy and it went way up. But I think in general, most people have seen those insurance premiums go up because your insurance company, it costs more to replace your car if you wreck it. And then thinking about the interest rates, the reason we pay attention to interest rates is the Fed raised rates. They were able to combat inflation. They feel like they've done a good job there. They will be lowering interest rates. They started that. In fact, I think they meet today and will announce this afternoon their next cut, when that might be, whether it's now or later this year. But the market believes that the Fed will kind of settle around 3.5%. The Fed believes it will settle around 2.9%. But we do think that for our more conservative investors, that this is a good trend for bonds. Bonds were very difficult. They behaved a lot like stocks in 2022. So stocks lost a lot of money in 2022. So did bonds. I've shared this chart before. What I really like about this is just showing you here. The dark blue shows if the Fed lowers rates by 1%, how are bonds likely to react? if they raise it by 1%, how are bonds likely to react? And if there's no change in interest rates, how are bonds likely to react? The Fed would have to raise rates pretty dramatically, and it really wouldn't have a tremendous impact on the bond market at this point, which tells you the bond market's probably about as beat up as it's going to get. It started to recover over the last 12 months, but I think as the interest rates either stay level or drop, I think bonds will do well. So if we go through a difficult period in the stock market, and statistically, it's been 2 years since we've had a difficult market, so 1 out of the next 2 years ought to be difficult. I think bonds will act as a good shock absorber and diversifier in portfolios. And for conservative investors, they'll feel really good because I think they'll do well. And if stocks continue to do well, that's okay. That usually will outshine what's going on with bonds. Just looking globally, I think, that, again, something to keep in mind here as we look, this is kind of a heat map for developed countries, emerging countries, and just broad things. And you'll see that if we look here, the US and Spain are really the strongest economy. US continues to be one of the strongest economies right now. We do have a lot of momentum. That's a lot of good things happening for us. Obviously, you're seeing some good activity in India, but China is struggling, as you know. A lot of Western European countries or developed countries are also struggling. So the US economy still is kind of the king. And so I think you know, as we think about going forward, what are the implications here? I do believe that barring some geopolitical major issue, which, you know, there's a lot of opportunities for geopoliticals to go wrong soon. I do think that the US economy is still growing strong, and I think that could translate to good stock returns. But that could change very, very quickly as well. And as I wrap up, I'll go back to a concept, but just think about it a little differently that we started with today. And that is this idea of staying diversified. And in 1 year, we can see the broad, if we look at that green bar, in one single year, stocks can be very, very volatile. And a bond portfolio can be somewhat volatile, but a blended portfolio, that gray idea, you know, over time, a diversified portfolio is going to be a lot less volatile and provide consistent and good returns. So even in a 10-year period, a diversified portfolio, worst case scenario, still should be positive, even though we've had 10-year periods where stocks were not positive. So again, it's just a reminder to stay diversified and invested now more than ever. When a few companies are making a lot of the headlines and driving the market, it's easy to get carried away with that. We were referred to a client who is very, very Tesla happy and has a lot of money in Tesla. And I think, oh my gosh, you know, if you look just at that one company and how volatile it's been over the last few years, that's a roller coaster I wouldn't want to be on. Personally, yeah, it's great when it goes up 100% in a year, but it's also really it can make you sick to your stomach when it loses 50%. So again, diversification and focus on the long term continue to be our message here with what's going on. I'm just going to wrap up here with a few disclosures and definitions that we put into this presentation. Again, JP Morgan is one of our fund company partners. We like their data because they refresh it pretty regularly. This will be recorded and put online. So if you'd like to go read all these definitions, we certainly encourage you to do that. But just again, past performance is no indication of future results. So I thought I would just give you a quick update as to where we are, but I'd also leave some time for questions and dialogue here, and we'll start there. I was certain we were going to get a bunch of questions on the election.
We can come up with some if you're asking.
I have said, and I think we're seeing that this morning. My stuff is markets are apolitical. They thrive on data and information. Markets exist for no other reason than to make money. doesn't matter who the president is. It doesn't matter who controls Congress. Markets try to make money all the time. And so uncertainty is the anathema to stock markets. Certainty is not. So I think, again, it seems like we have a somewhat certain outcome of the election. I don't think the House has been decided yet, or we know the exact result there. But we did know that it was going to be close. We knew that whoever wins the White House has a very narrowly divided Congress. And so I think the market, whether you personally like that or not, I think the markets take a great deal of comfort in that and feel like that creates the most predictable scenario.
Jim, you've shown slides before
Mhm.
when certain political parties are in
Yep.
power and all. You don't happen to have that handy. I don't know. It looks to me like Republicans are gonna sweep all three.
Yeah.
Branches.
Mhm.
Be interesting to know what's happened in that situation.
So I don't have that chart this time. I knew that when we were putting this together last week that the election would likely be over. And so I didn't include it. What I would say, ironically, is that most of the last 60 years we've had divided government. And so that's good.
And it's done well when it's been divided overall.
Yeah, and there's a slight edge. If you look at the last 60 years, I believe that Republicans have a slight edge in the stock market. But in terms of economic expansion, GDP growth, the Democrats have an edge. And my supposition from all of that is that it doesn't really matter.
Encouraging.
Is that, again, look, every politician would love for the stock market to grow 20% a year and the economy expand at 3% a year, and certainly would do everything in their power to make that happen if they could. And so, but I would also say, if we take a step further back, every time that we've had one party, and I think you can go back to 1980, so you can go back 40 some years, we've never given one party more than a 2-year crack at the apple. And that's, Bill Clinton, George W. Bush, Barack Obama, Donald Trump, Joe Biden, all had a majority in both houses the first 2 years of their presidencies and never again. And so, and right now, I think we're even a narrower majority than we've ever had if in fact the Republicans win all three. So I would suspect that dynamic will change very quickly or over the next 2 years. We seem to thrive on divided government. But who knows?
Sort of like diversification, isn't it?
Diversification. Yeah, and I think, yeah, so. Well, thank you for coming this morning. It's a beautiful day out, and I think the markets will do well today, and but I think longer term, I think the biggest risk to stock markets at the moment tends to be geopolitical conflict. I don't know what's going to happen with Russia and Ukraine. I don't know what's going to happen with Israel and Iran. I don't know what's going to happen with China and Taiwan. And I think if something were to happen in those hot spots, that could certainly, and particularly if the US gets drawn into any of those conflicts deeper than it already is, that could dramatically reshape what happens in the market and the economy in the short term. And that dynamic exists regardless of who won elections yesterday.